Hey everyone, Jeremy Portnoff here, back again for another market update video. Sorry it's been a little while since I did the last one, but I want to do an update here to kind of cap off 2022. For those of you who don't know me, I've been in the financial advice business since 2002, and since then completed a number of professional education and credential programs, a notably certified financial planner, certified investment management analyst, and chartered market technician. Now, as always, the purpose of this video is to provide you with a general update of some of the recent developments in the financial markets and to give you a sense of where we're at, what's happening, and some of my thoughts. Before we begin, let's take a quick look at the disclaimer. Go ahead and pause to read. Just remember that it's real important to understand that everyone's situation is different, and so you should always consult with a qualified financial advisor to assess how this information may or may not apply to your individual situation. If you'd like to discuss this with me, you can send me an email, give me a call, or schedule a call by clicking the link at the end of the video. As usual, I'll start with a summary of the general markets and then move into a review of my tactical portfolio in the second half of the video. Now remember, you can always watch this video at faster than a 1x speed by changing the settings. All right, let's get into it. Okay, so we're going to start off here with an overview of just the S&P 500. You know, the S&P 500 and the Dow, that's the kind of stuff you hear on the news, so I always like to start with that. S&P 500 is essentially just large cap stocks, so the 500 largest traded stocks. Just following some previous reviews that I've done, you can see that from the peak in January of 2022, to the end of the year here, at the end of December, you can see we're still very much in a downtrend. Stocks ended the year being down approximately 20%, depending upon where you measure from. From recent lows around mid-October, which is about when I did my last review, you can see that we're up almost 10% from those lows. So the market did rally here, and it did go a little higher. Now, as I've noted in prior updates, we've got that January peak, we've got this March peak, right? And at that point, the trend line here, this gray trend line was drawn. And I've just been kind of extending it over time. And you can see that as the market was rebounding off of the June lows, look at right where it hit, right? I would have gone over this in the last review, so I'll make this quick. But you can see that we hit that trend line, right? I mean, right there. It hit the trend line, which was also where the 200-day moving average, simple moving average was, and a lot of market participants look at those big moving averages. So there was definitely a lot of resistance there, which is why, a big reason why I didn't bother getting back in at that point. And you can see the market dropped further and went to the new October lows at that point. So kind of that decision not to get back in anything at that point certainly validated. Anything that I would have gotten back in would have either had to gotten back out quickly or might have lost a little bit on the trade. So I'm glad I kind of stuck with it and stayed, mostly in cash. I'm referring to the tactical portfolio. Come back to that later. Point being, we did see those new lows. The market comes up. Again, same trend line. Remember, I'm just extending it as time goes on here. Market's rallying, and look right where it hit. Let's zoom in there again. It hit the trend line, right? And the market backed off a little bit there into early December, rebounded, hit that trend line again, right? So the opening was actually right at that trend line, traded up a little bit above it during the day, and ultimately closed down for the day. And you can see the market kind of backed off from there. It's kind of switching back to that risk-off trade. So I'm just going to keep extending that trend line. But the reason that that's so important is you've got 1, 2, 3, arguably 4 tests of that trend line. It makes that trend line very significant to traders and market participants, the ones that are actually setting prices out there, right? And so we want to be really wary of any rally that's going up to that trend line. And a reasonable break of that trend line is where we're going to be looking for a potential recovery. But as we go on here, I'm not too optimistic about that for a variety of reasons we'll get into here as we go. All right, what else do we want to go over here with this chart here? So yeah, we're down about 20% from January. We're up about 10% from those lows. But we're really kind of, I mean, when you look at where we're at here, we can trace back all the way to about, May, right? Where those lows were hit. And so it goes up and down, but really not going anywhere since then. With the peaks, these more moderate peaks here keep backing off, and they're not getting back to that prior level, right? We go back here to June when we exceeded that level. That looked really, really optimistic there, but the volume started declining. I'll go over that in a second. But it was a higher high, so it was looking like, oh, maybe there's some potential here. But it had broken down, went back below, kind of retested that level, and then went to newer lows. So we kind of look for those sorts of changes in trend to see what's going on, and that was definitely a failure. And we kind of see a very similar thing happening here more recently, right? We can see a bounce off those lows, a little bit of a correction. We go to a newer high, so these kind of minor highs are higher, but we didn't quite make it there to that prior high. In fact, the resistance level that hit was very much where prices consolidated here and here before. So it's right around that like 4,100-ish level. We see it got tested here, and here. So again, when you look at prior resistance levels, you've got several points where that level, the market it hasn't wanted to go above it. Okay, so again, those we're not getting past those kind of more I won't call them major highs, but they're more prominent than just like a little peak here or something like that. So again, that trend is very, very much still pointed down. Now, talked about volume a lot, and volume and price are kind of the basics of technical analysis. They give us a sense of what's going on. So quick recap, we look at the trend of volume as it's occurring with the trend of price. So if price is going up and volume is rising, it tells us there's strength in the direction of that trend. If price is going down and volume is rising, again, strength in the direction of the trend. If price is going up but volume is falling, right, you still have a positive direction in price, but it suggests that the momentum is kind of waning. And the analogy I've kind of come up with this is, imagine, you're driving your car up a hill. If you keep your foot on the gas, you're going to go up the hill, continue going up the hill. Now, if you take your foot off the gas, the car is going to keep coasting up the hill at least for a little while, but the speed will start to slow down and you'll eventually reach a point where you don't go up anymore. So that's kind of how we look at with volume. And we've seen this before. I've gone over this in prior videos, so I want to focus a little bit more on what's going on recently. But the point is, when you get to rising price or falling volume, it gives you an indication that trend or that rising price trend is really weak. It doesn't tell you if or when it will actually turn around. It's just an indication. So far this year, though, it's been a really good indicator. And so we kind of see the same thing more recently. As we go from these October lows, you can see kind of generally in that bounce, volume was rising, right? But it was kind of looking a little bit choppy there. It's kind of hard to discern. I'm going to show you something in a second. But as we get into November, you see that big surge there in price. Let's zoom in just a little bit more here. Price goes up even higher, but again, it's happening, right, on declining volume, right? And then the market starts going down, and we see kind of volume rising. It's dropping off a little bit. What I've been doing is using this indicator called on balance volume, and what it does is it is a cumulative index. And so if it's an up day in the market, we add the volume to the line. If it's a negative day, a down day, we subtract the volume. And so it gives us a sense of that volume trend along with the price trend. And there's a couple of points where you see, I'll give you an example going back. This is September of 2021. If you look at how the market was rising during this period and you see the on-balance volume indicator down here, it was also rising. So one kind of confirms the other. You get a little dip in the market, on-balance volume dips, fine. Market starts going up again, on-balance volume rising again. So far, so good. But notice right there at that point in early November, you kind of hit a peak in that on-balance volume. And then as we go over to the right with price, you get a little bit of volatility, and then you hit that high, that newer high there in January, right? But that on-balance volume was lower. That's a divergence, right? Because you have higher price, but lower on balance volume. And we've seen that trend occur. So while the on balance volume has generally been declining, we can look to certain periods of time, like where this point is in February to the peak here in March, right? And you can see from here to here that on balance volume was lower. So that would have been an indication that rally was kind of petering out. And you see the same thing here in that August peak, right? We had price kind of consolidate here in May, early June. Notice where the on balance volume is, right? In fact, let me pull this guy over here. Let's mark that right here. There we go. So you can see from that point, notice that red line down there, right? You got a higher price, lower on balance volume. That's why, one of the reasons why I wasn't excited about that peak, and then it ended up coming down, right? So it's kind of been a repetitive theme, right? So getting to where we are now, let's take it just from these October lows, right? Same thing here, right? You got this nice rally that occurred, right? But the on balance volume continues declining. Even if you just measure from that short-term bottom there to about here, it's still, let's look at that. Let's move that for a second just so you see what I'm talking about here. Even here, just from this point, you can see that the price had rallied substantially, right? Almost 20%, but that on balance volume was flat, right? If we measure from where we are now, which is still a higher price than that low, but again, that on balance volume. So again, this rally was not looking strong, and of course it backed off. So that's a big indicator, something I've been following. It's one of the more basic ones, but I think it really paints a really, really good picture about what's going on. So that's kind of the general thing that we're looking at. The market keeps trying to rally, doesn't quite get there, and it backs off. There's a number of things going on. We'll get into some of the economic charts here in just a moment. But you can see that from peak to the recent bottom being about 282 days. So if this is a more substantial decline than like we've seen in the past, I would expect this to last longer. I would expect that we might see some lows that take out those October lows. And my concern actually for that is if we do take out those October lows, I think that's kind of the oh no moment. We've seen that in the past where, let's go back here just a moment. Bear with me. Let's go back to some of the more the bigger declines, right? Here's your 2006, 2007, right? Market had peaked here in 2007. It dipped, went back, did see a new high, and then it started going down. Now, you had a series of, ups and downs, but the trend was clearly down, right? And you can see there was a low that had been put in March of 2008, rallied nicely, but then it came down, it made a new low, started rallying a little bit here, and you get into August, into September of 2008, and then it really just fell off a cliff. That was the really, really bad part. Now, keep in mind, the market had obviously been trending down for quite some time before that, but this was kind of that oh no moment, right? And that's kind of what I'm looking for. I expect that something like that is going to happen because there's been so much stimulus. The Fed's not stimulating anymore. In fact, they're tightening. So I'm kind of waiting for that other shoe to drop, if you will. And I think there's a particular reason it could happen. I'll get into that when I go over the tactical portfolio. So that's kind of the main thing here. I did want to point out here, where is my Fed lines? Where did that go? Oh, there we go. Fed meetings. So these lines represent the Fed meetings. So each time the Fed's met. So sometimes after those Fed meetings, market goes up. Sometimes it goes down. It's really been, flip a coin. So, but it's just been something interesting to watch. Fed will be meeting here again in another month or so, and expected to raise rates some more. But I'll come back to that in a little bit. So, all right, moving along. Probably spend the most time on that S&P chart, and we'll try to go through the other ones a little bit quicker. Volatility, the VIX, it's been declining since that mid-October low, and it's gotten back down to kind of that 20 level. And that's been another kind of recurring theme throughout this bear market here. Every time volatility gets down to about that 20 level, then you start to see the market going down, volatility rising. So it's up a little bit in the short term, not a lot, but you can see we saw a low there early December with that VIX, and it's been rising. So something to continue to keep an eye on. Now, looking at mid caps, we're gonna flip back and forth a little bit here, but we want to see where are the differences in what's going on. And so you can see, as far as mid caps go, also still very much trending down. Similar kind of trend line that's been retested a couple times. And you can see here in late November, it did exceed that trend line a little bit, not for long. I would call that a throwback rally. Well, I mean, it was a rally, and then there was a throwback, right? And then we go under it for a little while. So it's still very much trending down. Mid caps, not down as much from the peak as large caps, about 16.5%, up off the bottoms of about 11%. But you can also see that mid caps kind of have been going sideways for quite some time. We did get a higher high here in November, so they peaked before large caps did. But this mid cap market's been kind of going sideways now, almost 2 years. Well, I shouldn't say sideways anymore. It's really clearly down from that point. So when we compare that back with large cap, you can see that large cap peaked later in January and has been trending down since then. But large caps are down a little bit more. So those mid caps have held up slightly better, not that much though. Okay, small caps. Kind of a similar view. Trend line a little bit different. That peak there in March didn't quite get there, but it was close. But you can see it retested a similar trend line in other places. So again, it's very much still in an overall downtrend, down about almost 22% from the peak, which was also November. So mid caps and small caps peaked before large caps did. But notably, and this is something I talked about way back when, but here you can see from March of 21, mid caps kind of went sideways for a while. You started to see that rise there into November, thinking, oh, this might be good, but then it ultimately backed off and went down. So that was one of those early warning indicators. And so when you look from the recent lows, right, you see small caps are up, not quite 10%, not quite as good as large caps, right? So I don't know. It just seems it just doesn't look good, right? Now I'm going to break down the growth versus value, and that's kind of the important thing that we want to look at. But again, most of the longer term trends, intermediate and longer term trends, are all still pointing down in stocks. So it's just not looking good, at least not yet. Okay, as far as yields go, we were looking at the 10-year Treasury, and let me hide that there, just make it a little cleaner there. The yield has been clearly rising here. We saw those lows back in March of 2020, and they've been rising quite a bit. And we did see that yield start to approach almost 4.5%, which, we haven't seen these kind of yields, right, going back into here's 2010 and then 2008. 2007, right? So we've been a little spoiled with low rates for a long time, which has helped to fuel a lot of the economic growth and stock growth and whatnot. So now that as yields have been rising, it's making it more difficult. The borrowing costs are more expensive. Valuations for stocks change. That's one of the reasons why growth stocks have gotten absolutely hammered. And so the yields were backing off a little bit. I mean, it went from about 4.3 down here to about 3.4, but they're rising. They're kind of reversing that trend again. So we do see some of those kind of typical ebbs and flows like we do see in stocks, but it's different, right? But in the sense that you get kind of a one movement, you get a little bit of a retracement, and then another movement again, kind of seeing the same thing. So I do expect yields to continue to rise, just simply because the Fed is raising rates. Now remember, there's a distinction between rates in the bond market and the federal funds rate, but they do have a very high correlation. In fact, there are many who believe that the Fed raises and lower rates in response to the bond market. Whether or not that's the case or not, you'd have to talk to the Fed chairman about that. But basically, Feds continue to raise rates. They are reducing their balance sheet, which means they're selling their bonds. And so when you got a big seller of bonds, it's putting pressure on that market. The only kind of potential buoying effect here is that when you have stocks going down, you have a lot of institutions that are buying bonds, right? So that could put a little buoy to the market there. The other thing is there's a lot of bond managers out there that believe that because rates have gotten where they are, it's starting to become a good buying opportunity. I think that's what has fueled the recent rally. But again, with yields starting to rise again, we're kind of giving that back, so to speak. So when you look at an aggregate bond fund, I like to use the AG for that. You can see that the bond market peaked here back in August of 2020 and is still down almost 16%. That's kind of been the big surprise that really not a lot of people were expecting, because you just don't expect bonds to go down that much. If you look from that November peak when stocks peaked, you're still down about 14.5%, and even if you measure from January, it's probably about 14%. That's been pretty rough, especially for conservative investors experiencing those losses of that magnitude in both stocks and bonds. So even when you see a stock market decline, in many markets in the past, it was kind of offset by the bond market giving some positive returns. And so we haven't seen that. That's what's made this decline that much more painful, especially for conservative investors and retirees. And that's kind of a symptom of one of the problems, and what makes this market different is what's happening in the bond market. All right, moving along. Average mortgage rates. I'm going to go over just some of these economic charts. You can see it peaked out here over 7%. So we moved from, call it about 2.6-ish% back in January of 2021 to over 7%. I mean, it almost tripled, right? And it's backed off a little bit since then. There's a very, very high correlation between mortgage rates and the 10-year Treasury. So they backed off a little bit, but now it's kind of rising again, starting to get back closer to 6.5%. This is causing some problems in the housing market. Now, this, to me, has not been unexpected. I've been expecting this to happen for a long time. It's taken a long time. You can see this home price index, Case-Shiller home price index, where it peaked here in 2006 and how much it went down. It's kind of a national index, so some areas that bubbled more came down more. But what I want you to notice here, so after kind of bottom 2012, right, prices started going back up. You hit a recovery point around 2016, 2017, continued going up, and then you get into the pandemic, COVID pandemic, and just boom, prices just skyrocketed. Again, we had those super low interest rates, and so that really helped to fuel buying with real estate, because nobody cared what the price was, because people buy homes based on mortgage rates or mortgage payment rather than the price itself, and so it just fueled this crazy boom. But what's notable here is look how fast it has turned around. It has really turned around very rapidly. So even in the financial crisis, it started going down more slowly, and it took a while before the declines were really happening. This is a big hook turn here. It's not big in magnitude, but speed, right? And so definitely keeping an eye on that. As we approach this next real estate selling season in a couple of months, I think that's when you're going to see a lot more declining as these interest rates are really setting in. It's going to be harder for people to buy homes, which is going to make it harder for sellers to sell. You're going to have to get more aggressive pricing. You're starting to see more supply. There's some other stuff going on with some of these REITs, these real estate index trusts, and that have been buying, corporate buying up lots of property, and some of the funny business that's been going on there. They start to release that supply on the market. That could really put a big decline in prices. So definitely something to keep an eye on. But I don't see how prices could go up from here. I think they're going to trend down for a while, one way or another. I think it's a matter of how fast do real estate prices come down. Whether it happens slower or faster, as opposed to, I don't think it's a question anymore. Are they going to go down? They're going down, and I think it's going to continue. All right, the big story this year has been that federal funds rate, the Fed raising rates. That's this chart, right? So you can see that we had near zero interest rates going from the financial crisis for many years. And then the Fed started raising rates there 2015, 2016, 18, 19, and then they started lowering rates. Now, note, this is before COVID happened, right? There were indications that recession was on its way, and you can see that in the yield curve chart, which I'll show in a moment. But they went right back down to zero interest rates for the pandemic, and then inflation started taking off, right? And you get into early 2022, and then they started these aggressive rate hikes, these 0.75% rate hikes. And so they have continued doing that until the last one was 0.5%, and the market kind of got excited about that because it wasn't a 0.75% interest rate hike. It was only 0.5%. And it was on the news that inflation looked like it was moderating. And so when we look at that inflation and we see what's happening, actually, let me skip ahead here for a moment. Here is a CPI chart, so you can see how fast this indicator was going up. And then you can see it's kind of starting to moderate, right? It's still going up, though, and inflation is still high. It's just going up at a slower pace. And that's the market kind of getting a little bit excited about that. When you look at PCE, which is personal consumption expenditures, also a different kind of inflation indicator, same thing. You can see it's really going up, 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 and then you get a value here it's still going up, it's still high, it's just at a slower pace. And so this kind of sparked a rally in the market, in the bond market, because the expectation is that the Fed is going to what they call pivot and start lowering rates again. So the kind of consensus is the Fed's going to push the economy into recession, and as that happens, then they can start lowering rates again, and the market gets excited about that. But I guess maybe I'm just a contrarian. I see things a little bit differently because you've got the market raising rates. The Fed raising rates, pushing into recession with this, high inflation, but the inflation is still high. It's nowhere near their target. The target used to be 2%. Even if they make their target like 3%, we've still got a ways to go to get there. And so I expect the Fed's going to continue to raise rates for a little while, which is kind of going to exacerbate the notion that we're headed toward recession. It's going to make that worse. We'll see that in a second here as we look at the yield curve. But that's kind of been that big story, and that the markets have been kind of just waiting on bated breath of what the Fed's going to do. And so it's been kind of interesting, to say the least. So the yield curve is we take the longer 10-year treasury and we subtract the shorter 2-year treasury and look at the difference. And so when it's going down and it hits this black line here, which is zero line, that means that your long-term rates and your short-term rates are the same. When it goes below it, we say that the yield curve is inverted. It means that the longer-term rates are lower than the shorter-term rates, and it's a sign of recession. So if we pull this chart back again, I'm going to go through this real quick because I've talked about this probably ad nauseum. But pink shaded areas are where the yield curve inverts, and then the gray shaded areas are recessions. And you kind of see it's very repetitive. Invert, recession. Invert, recession. Invert, recession. Right? We got really close here in the mid-90s and everybody thought we were going into recession at that point. And I believe the reason we didn't is because the internet happened. You had this major economic shift, and it really just changed the economy and the global economy. Otherwise, we were heading towards recession. So it's a pretty good indicator. Not perfect, but pretty good. What's notable here is you can see how inverted this got recently. And this is more inverted than financial crisis, more inverted than the tech bubble bursting back here to 89. So the last time it was at that level or worse were the 80-81 double dip recession. So and that was coming off a period of really high interest rates in the 70s. So it's definitely a very concerning thing when we look at that. I want to spend a couple minutes here. This chart might be kind of hard to visualize here, but we're looking at an ongoing chart of the yield curve, and what we see here, I want to point out as I change the graphic here, right? You can see I can move it all around, which is kind of neat, but I kind of get a certain angle to see what's going on here. You can see as I'm on the chart over here in the right hand corner, it shows that yield curve from the short term to the long term. And so what we're seeing when we look at into 2020, right? Actually, let me pull this back a little bit more. There we go. So before COVID happened, you can see that interest rates were generally declining a little bit, but you had a normal yield curve where the longer term rates were higher. And so as we go on, you can see that that yield curve was starting to flatten. And then you see overall rates, the whole curve was dropping, right? Excuse me. We get into 2020 and it kind of started steepening again, right? And it kind of remained that way for a little while, right? Until we kind of get into right around there, early 2021, you could see that it started kind of flattening a little bit as we proceed 2021. Right, let me zoom this in a little bit more now so we can see that a little bit better. There we go. So you can see late 2021, right? Still a normal, longer term yield higher than short term. So still normal in that sense, but rates in general were rising. And you can see that shorter term rate rising faster than the long term rate, which is where you're starting to get that flattening effect of that yield curve, right? And it kind of continues on, right? Until you get around this area here, we can see it's very flat. And we continue on. Let's move this a little bit. Right? You can see how it's inverted. Right? So rates were rising, but the yield curve itself was inverting. So as you get to where we are now, right, you can see it's still inverted. And this is going to continue to cause a problem in the credit markets, the banking model. So that's one of the reasons it's a sign of recession. So we'll see what happens with that. Who knows? But it just doesn't look healthy. Unemployment rate is still low, which is one of the reasons why some of the economic people say, well, we're not in a recession yet because unemployment's low. I've talked about this before as well. You got a lot more people leaving the workforce. Let me show you that here in a second. Initial claims for unemployment have been rising for a little while now, not too significantly, but here, labor force participation. This actually peaked in 2000. So the labor force participation has been generally declining since then. You can see where it fell off a cliff here with the pandemic, and then it kind of has recovered to some degree, but not that much. If you look at the demographics, right, 2000 was about the point where the earliest of the baby boomers, meaning people that were born in like the mid 30s, that's when they started retiring, right? You take the mid 30s, you add 65 years, you get to 2000. And so that's really when the wave of retirement started with the baby boomer generation. And that's why labor force participation has been dropping. And so this chart really shows that, which is why that unemployment rate really isn't a good indicator of what's happening in the jobs market. Because you have fewer people simply being counted, right? So it just creates an issue with that particular unemployment metric, right? I think that's about it here. Well, I'll show you real quick. I just added some charts recently for federal debt. So here's the federal debt, and this is where I get to pick on all the politicians, whatever president or administration is in power at the time. I mean, take it back here, and they all have added to the debt for the most part. I mean, there was a brief time here in the 90s where it didn't increase at a fast rate, but pretty much every presidential administration since then, I mean, it's just more and more debt at an even faster pace, and like this thing has gone parabolic, right? So you're looking at let's see, the early 80s and mid 80s, that was like Reagan and Bush Sr., and then you get into the Clinton years and still adding debt, maybe not as bad. But again, you had the internet happening at the time, so economic growth was great, tax revenues were great, so that was good for government revenue. Get into the Bush years, you see it raising at a faster rate. Bush years are over, Obama takes over, but you got a financial crisis, so they had to stimulate and do what they had to do, and so you can see that federal debt increasing at an even faster pace, right? And again, I like to, in this case, pick on both sides. I'm not picking a side here. I want to make that clear, because I do believe if it had been a different, like Obama, for example, if it had been McCain that got elected, they still would have had to deal with the financial crisis, right? And they still would have had to stimulate. So it still would have gone up, maybe more, maybe less, but generally it would have done substantially the same thing. You get into the Trump years, and it's increasing at an even faster rate. And then you get into the pandemic, and it's just like, boom, it's going parabolic here. And you got the early Biden years, and it's keep going. So the government spending is just insanely out of control, and it's all of the politicians. They're all doing it, right? So it's really not fair to beat up on one over the other. They're all doing it, and this is a problem. So when we look at federal debt to GDP, this is actually kind of the scary chart, because we're looking at that percentage of that federal debt as it relates to economic growth. So if the economy is growing and you're adding debt, that's okay as long as it's not going up too fast. So for example, and again, not to play a favorite, which is not what I'm doing, but just noting that you go into the Reagan and early Bush years, right? That debt to GDP was still rising. You get into those Clinton years, it actually did fall off for a little while there because the economic growth was so good, right? You get into those Bush years, it's now rising. It doesn't look that bad in this percent to GDP because the economy was growing for the most part, right? And so you get into the financial crisis, now the economy is not growing and you're adding to the debt and it skyrockets. What's notable here is that we hit this kind of level of 100% debt to GDP, and there are economists that believe that once an economy hits that 100% debt to GDP, it's going to struggle to grow from there. And so you can see we kind of in that range for a while there. Again, pre-pandemic, pandemic hits, and that debt to GDP, sorry, tongue twister there. It just spikes like crazy, right? Again, because the economy basically almost stopped. And you added a ton of debt very rapidly. So it's backed off from there. We hit about almost 135%. We're currently around 120. This is a major problem because you're adding more and more debt. We had a ton of debt before, but you're adding more and more debt, and the cost of that debt, the interest rate, the yield that the government has to pay is even higher. So as the older debt rolls over and they have to issue new debt at these higher rates, that means a larger and larger percentage of government revenue, our taxes, is going toward just servicing the debt. This is where it gets very, very concerning. That's one of the things that I'm just not too optimistic about. So anyways, Fed balance sheet, you can see that it's been declining a little bit because they're selling the bonds that they used that were stimulus. So again, not really painting a very good picture here, but my expectation is what the problems that caused the markets to go down here in 2022 are going to continue in 2023. Now, remember that recovery tends to occur in the stock market before economic recovery, right? And so that's something we're going to be on the lookout for. All right, so let's go ahead and switch gears and let's take a look at the tactical portfolio. All right, here we are. So this is a list of the holdings in the tactical portfolios, and I got a little bit of a heat map, if you will, over here of the moving averages on the right side. So 5-day moving average is it up, 21-day, which is kind of your 1 month for the market. It's the 5-day above the 21. Is the 50-day, which is kind of your quarter measurement, a little bit shorter than a quarter. Is that up? Is the 5-day above the 50? And is the 200-day moving average up? And you can see there's some green there, but there's a lot of red, right? So most things are still trending down. All right, let's break this down. I'm going to try to go through this quickly because I know this video is getting a little bit long. I hope you remember to put it on a faster pace if you'd like, right? You can always pause and reverse and whatnot. So here is a large cap. Oh, wait, I'm out of order. Hang on. There we go. Large cap growth, S&P 500 growth. And so what you can see here, again, there's the point that I exited, so what the initial drawdown before exit. There's how much the market's gone down since I exited, and then I've added how much it's up from the bottom. And so you can see that growth stocks are down quite a bit still, right? And even the rally off the bottom was limited, and it's given a lot of it back. So basically, the majority of the decline in the S&P 500 is because of growth stocks. There's a lot of growth stocks out there that have already gone down 70, 80, 90% when you look at like individual holdings. So growth stocks have just gotten absolutely hammered, right? And you can see that peak that occurred there right at the end of December. So when we look at large value, we see a very different picture, right? We can see where we peaked here a little bit later in January. less of a drawdown before I exited, but you can see it's just been a lot of volatility, and the recoveries that have happened have been pretty substantial. Now, I never got back into any of these, and basically my reason is, as I've said before, I'm just playing this really conservatively. And kind of getting to my other point here, you can see that where the large cap value is right now is very close to where I originally exited. And so from the standpoint of we just haven't participated in the volatility, to me that's still a win. If I had been more aggressive, probably would have gotten in at a lower price here, but it just didn't look good, and I said I would play it conservatively, and I have. As it got to, this prior peak here and, consider getting back in, it's like the rest of the market just doesn't look good. It did go to a higher high here, but then it backed off, and so I continue to wait. And so again, we got some consolidation around this area here. So, I kind of want to get back in, but I don't, and that's really been a tough one. But right now, it's just going sideways. Low volume because of the end of the year, not surprising. So I'm just kind of waiting on that. But again, the point is that large cap value has held up far better than growth, right? And so what is the thesis for the stock market going down significantly? It's when large cap value and value stocks in general then really start going down, right? That's the other shoe that drops, and that's where I think it happens, right? And so that's why I've been kind of concerned and not wanting to get back in these positions. Now, when we move on to mid caps, we see something kind of similar, right? Mid-cap growth, again, exit point, how much it's down, how much it's up from the bottoms, but you see kind of that same general trend. Lower highs, right? Market, where it was several months ago, but you have, again, you look at the growth, right? Mid-cap kind of held up a little bit better than the large cap growth, right? Because we can see large cap growth is still down, a good 30% or so, whereas that mid-cap, not down quite as much, right? Again, we look at a mid-cap value. We see a similar picture to large cap value. We're below where I exited by about 4%. It's about almost 13% off those lows, but it's done the same thing in terms of those rallies couldn't quite get back to where they were previously before backing off. So even mid cap value has not held up as well as large cap value, right? When we start getting into the small caps, right? And as a reminder, small caps peaked way back here in February of 2021. Right, kind of traded sideways most of that year, and then we're starting to go up here into November 2021. But that small caps had already been down for a while. That was one of those indicators back in 2021 that I was telling everybody, like, this doesn't look good because you only had large caps that were going up, right? And so, of course, they're down about 23% from where I exited. But the point being that small cap growth has done way worse than everything else, right? And even when we look at small cap value, right, we can see that small cap value is still trading below where I exited. It's still done a lot worse than large cap value. So large cap value has been that one asset class that has kind of done better than everything else, but everything else has kind of struggled more, right? And so again, with mid caps and small caps in the value category underperforming large cap value, again, it tells you that the majority of the market is still very weak. When you only have that one category going up, it just doesn't inspire confidence, which actually is a big reason why I have just waited on the sidelines on that, not wanting to take that risk. So you can kind of see there that where that hesitation is, because a lot of these asset classes are still very much struggling. When we look at micro caps, again, very, very small cap, still about 24% below where I exited, and less off of the bottoms, right? Only about 7% off the bottom. So that's just not looking good here. It's actually trending up in the very short term, but your medium and longer term trends are still down. Foreign stocks have actually held up pretty well, and I'm kind of debating getting back into some of these positions. They're still down about 14% from where I exited, about 16% off the lows, and you can see we actually did exceed those August highs just by a little bit, but then it backed off. So then it's like, okay, we really would like to see a more substantial break above that. Now, where we're at now with something like that is, we've exceeded that level, retraced back down here. If it can rally back up above and even take out that high, I think it's a really good indication that foreign stocks could possibly lead the way. But again, lots of weakness out there, so I've just been waiting. Foreign large value, kind of a similar story, right? Didn't get hammered as much, has recovered a fair amount, but still below the exit, still well below the peak. You can see it's still very much a general downtrend. The December highs here kind of took out those August highs, but only by just a tiny bit before backing off. So again, it's really worth waiting on. So I'll go through the rest of these a little bit faster. So small cap. Foreign small cap, again, they're off of the lows pretty good, but still very, very much in the downtrend. So still waiting on that. Emerging markets, again, still very much below the point of exit and the highs going back here, February 2021 also. So it's kind of a still wait and see. Real estate got clobbered, not surprisingly. It started to rally there, but again, just lots of failed rallies here. Still being down almost about 27%, so I'm staying away from that. Foreign real estate has held up a little bit better, but not by much, right? Still down 31% from its peak. It's up off of those lows pretty good, but again, I'm not making any decisions on anything like that just yet. Preferred stocks, which I've been looking at, but they keep going down. So, down 26% here, only 2% off the lows because it's been reversing. So I'm staying away from that for now. Variable preferreds, very similar, right? Didn't go down as much. It's about 17.5%, but it's getting back to those recent lows. So we're going to stay away from those. Now, gold is something I've been eyeing up, and I thought about getting back in recently. Every time I think about getting into gold, I shouldn't say getting back in, just taking a position. Every time I think about, well, maybe it's time to start doing that, it backs off, right? But it's been generally trending up, and so it goes up and it goes down. Recently, you can see here, it kind of hit this level here in middle of December, backs off and keeps retesting that level. So I think there's some resistance there, but there's been some positive trend in gold. I saw some charts suggesting that the dollar weakening has been allowing gold to rise. So normally gold is an inflation hedge, but because the dollar has been so strong and trending very strongly, the past year or so, it's kind of prevented gold from rising. So with the dollar weakening lately, that could be that fuel for gold to rise. But when we, again, put a chart like this in a context, and you can see the level of where it's at right now. I can take this all the way back to, here 2020 is at that level. And then going really far back, you can see here 2011, it was at those levels. So, it's obviously had times when it went down and it went up. That is true. So we're gonna focus more on the short term, but I might take a position on this soon. I'm not sure yet. I'm kind of, like I said, waiting it out. Commodities peaked a while back here in June of 22. Had that decline from there and have really been kind of trending sideways. So when we look at our intermarket analysis, that's one of the things that the fact that commodities have peaked is suggesting, recession. So we'll continue looking at that, but I'm not going anywhere near that guy. Global Natural Resources, which is also a commodities fund, has been really volatile and it's been getting a little beat up on this guy. We'd gotten some returns, it went up and then it dropped very sharply, so I exited. Then it rallied again, I stayed out, it came back down, made some newer lows, but it's been up off those lows quite substantially. And same kind of thing, every time I think about getting back in, it backs off, but the trend went up, and then it's backed off here. So it's only a couple percent below where I exited a while back last year. So I might even just bump this off the list because it's a little too volatile, I think, for my strategy. But I'm still looking at it. So. Short-term bonds have had some losses, really more than I would have expected, but the bond market has gotten so hammered, and that's why. So there's some minor positions left in this, but I'm also in the tactical models. I might even just bump it from the portfolio. In the fully invested models, yeah, it'll stay for sure. Aggregate bond fund down about 12% from the exit, so we're still doing good there, and it's trending down recently. The long bond was also rallying here. There we go. But it's backed off, so it's about 8% off its lows, but you can see it's still at about 38% from its peak. So, again, bond market's been pretty bad. High yield bonds are also in the red. 11.3% down from where I exited, and a little bit off of the lows here, but it's been trending down recently, so we're not going to do anything with that. Inflation bonds were also starting to rally, and then again, like other things, failed rally, and now it's only about 2% off of its lows, so nothing happened in there yet. And then last two here, and we'll be wrapping up. International bonds up off the lows by about 15%, and arguably consider to get back in soon. But same kind of thing. Looking at those August highs, we kind of approached that, and then it's backed off. So I'm in the camp where I'm just going to kind of wait. Still down about 22% below where I exited, right? So these bond funds have gotten really hammered. Now we've avoided most of that loss, and that's really what we've seen in a lot of these charts, is that the tactical strategy has worked. So here's your emerging market bonds, again, also up off their lows, but it's still down about 16% from where I exited. So, we're seeing some rallies here at the end of the year there, but I think the kind of overriding message that I want to convey is that even though we're sitting in cash and cash doesn't really earn anything, we've avoided loss in these tactical portfolios to a substantial degree, even with some of the positions where some not so great trades happen, and that's part of it. That's what happens. You get whipsawed from time to time, or like large value. I haven't wanted to participate in it because everything else is not doing good. So it kind of biases some of those decisions. But overall, we're really doing fantastic in these models. And if things melt down from here, I mean, we are in fantastic position. So even though this kind of paints a really gloomy picture, we're in a great position to weather that in those tactical models. Now, anything that anybody has that is fully invested and intended to stay fully invested, you just got to kind of hang on, ride the roller coaster, do some rebalancing periodically, and just kind of ride it out. That's a little bit tougher to do, but. So I can't say that I think there's going to be a better outcome for this next year, but we'll see. I'll try to resume doing these updates, a little more frequently if I can. And of course, if you have any questions, let me know. And I'll just wrap up here with the immortal words of Billy Ray Valentine from the movie Trading Places, of Merry New Year. Definitely one of my favorite holiday movies. It happens to have a financial, story there. So if you've never seen it, and if you happen to like Eddie Murphy and Dan Aykroyd, they're fantastic in that movie. But anyways, Happy New Year to everyone. Again, if you have any questions, give me a holler. Thanks for listening.